It's like $30,000 more dollars. But that's only if you did everything perfectly.
The Weekly Friedman, your source for the most essential information in the default industry. With your host, Adam Friedman.
Government-backed loans are vital to the U.S. housing market, supporting millions of homeowners, including veterans and rural communities. But when these loans default, servicing them brings unique challenges with high stakes for borrowers, servicers, and the economy. Today, we're exploring what makes government loan servicing different and why it matters. I'm Adam Friedman, managing partner at Friedman of Artolo, and I'm joined today by my good friend Candace Russell, vice president at Carrington Mortgage Services. Candace has over 17 years of experience in loan servicing with a special emphasis on government loans and is therefore an ideal guest to help us work through this topic. Thanks for joining me today.
Thanks for having me.
All right, so let's jump right in. So could you walk us through the key differences between servicing government loans and non-government loans?
I'd say for me, the alignment is different. So when I refer to GSE conventional, I'm referring to Fannie and Freddie mostly. And then Govy is FHA, USDA, VA, and public Indian housing. The alignment is different because for the GSE, they're looking to be a little similar under the FHFA. They have similar goals. They're competitors, but they need to have some sort of alignment between the two processes because they have that government backing. That government sponsorship. That's what GSE means, government-sponsored enterprise. So whereas the Govy loans, everything backed by Ginnie Mae, VA has a very specific goal to give a benefit to veterans around home ownership. USDA is specifically related to rural housing, non-farm rural housing. It has a goal related to its constituents that it's trying to serve. Public Indian housing, that is specifically related to reservation and Indian tribe lending, whether on reservation or off, depending on the program. And FHA is all about first-time home buyers, lower credit box, riskier loans, having an opportunity to come into the system. Those things are going to operate possibly very differently because you're lending very differently for very specific reasons, whereas the other is more generalized. You're lending to a general population based upon similar risk characteristics and more common prudent lending scenarios. So for me in servicing, GSE has its own alignment, even though they're a little bit of competitors. And then you've got this attempted alignment of government loans. As much as they can, they will try to mimic each other when it makes sense, but they can't always. They don't have the same Code of Federal Regulations that they work under. They do not have the same handbooks. They don't always have the same reference material. Some of the housing acts only apply to one portion and not another. So they've got some legal constraints around mimicking each other often.
Your perspective is very interesting because I think in the industry, the way we're normally thinking about it is this is a guideline or this is a requirement. And it's interesting. I don't think everyone is often thinking about it from the justification, right? They're lending for different reasons. So their regulations and rules are different. I just think that's an interesting way of putting it. Speaking of the regulations and requirements, are there certain requirements that you think are the most challenging for servicers to manage?
Absolutely. So I like to say that I really love untangling Christmas lights. There's just something, set me down, let me hyper-focus and get those things untangled. So I tend to love the Govy space, where other people may not love the Govy space, because I'm not going to say it's more difficult, but it is complex for those very reasons. And because of the complexity, anything that has complexity and outliers and parallels, but not exact paths, those are going to be more complicated to service. And the more complicated you get, the more risk is associated. So people often say, well, why would I want the risk? Because they're not really saying, why do I want the risk? They're saying, why do I want the complication that brings in the risk when I could opt for something that possibly is a little more streamlined or aligned? So the things that I think are most challenging with that kind of servicing is when we were talking regulations before. There's some regulations that haven't been changed since like 1982. My entire life. They haven't
Yeah, it's
been
interesting.
looked at. They haven't been changed. And when they were updated, it might have been 1997 for some very small portion of it. And some of them require an act of Congress or a House Act to change that core function. And I'll give an example of this. FHA is the only one that has what we call a conveyance time frame. None of the other govies have a conveyance time frame. And this is a time period of 30 days where after the foreclosure, you have a time for foreclosure, redemption, ratification, confirmation, or occupancy, the vacancy being. So it's the latter of those three, but I use foreclosure off.
Sure.
But when the latter, that you have 30 days, that 30 days hasn't changed in 30 years. Nobody's been able to go back and have it change because it takes a congressional change. And you have to go to Congress and say, why do we want this change? And why is it worth you putting your time into to change this? And there's just no reason to look at the rule other than it is hardship on all the servicers.
It's interesting. I mean, again, you always kind of think in the industry, we're always thinking, banks have red tape or there are these different things that you have to kind of get over. But when you're talking about the government and actually having to go into Congress to get a change, that's a whole different animal. I mean, in terms of the time commitment and the time, like just that's a whole different animal.
It has to
totally
be
different situation.
It has to be worth it to bring it
Right.
up. So you have to say, well, what's this really costing? What's this? Is it frustration? Is it confusion? And if it is frustration and confusion, at what level? Because we've got to put this in a congressional bill that has to pass the House. Like we have to get this through everybody for a final sign off, and then the entire industry has to agree that they liked the change.
Right. And then making another change is even harder.
It has to have a reason, which, by the way, I could argue that I think that there's a benefit in changing the 30-day time frame because that's one of the hardest things to meet sometimes. Sure. It's also one of the more expensive things to get wrong. So I would just say that hasn't been looked at in quite a while.
Sure.
There's reasons for it, but I think we could argue that those reasons affect enough that we could get it into some bill. It's just it has to be important enough to either administration, whoever's sitting in the seat, to tag it into something.
Sure. You mentioned risk, right? So for someone unfamiliar with the space, what are we talking about? And you just mentioned expense there for making a mistake. Like, what are the risks? If you're servicing one of these loans, a government-backed loan, and you make a mistake or you don't hit the 30-day time frame, what happens?
So I want to talk here in relation to the reward is great as well. So one of the best charts I feel like I ever saw in my career was very early on. Somebody said, this is on a defaulted loan. So we're talking about something that failed the process, didn't make it through on a defaulted loan. This is what you would make with a GSE. And they had $100,000 being the unpaid principal balance. And they're telling you, okay, it covers this much. The expenses were this much. So they did the same chart for each one. And essentially, the reward on an FHA, if you did everything perfectly, was like $30,000 more.
Wow.
On a defaulted loan. But that's only if you did everything perfectly. So there's reward to this as well. But the risk is if you the biggest risk with HUD in general is if you miss timeframes. There's timeframes associated with initiating foreclosure, completing a foreclosure, and conveying, i.e., having it foreclosed, ratified, confirmed, redemption, or once it's vacant, going to HUD within 30 days. All those push together and you get a certain amount of time. And the thing is you earn interest, debenture interest, on the days that you hold it and the expenses that you make if you do everything perfectly. But there are aspects to the language that say, if you mess up, if you miss this, if you miss this date, if you miss this reporting, if we believe that there is surchargeable damage, which has about 6 very defined definitions and then 1 very subjective definition, then we can negate the whole claim. That's the risk that you play when you're servicing these, to not fall into one of those timeframe holes or a possible review decision that says we think you could have or should have done better here.
Do you think if the timeframes were changed, like let's just say Congress does change something and loosen some of these restrictions, do you think it would then be appropriate for the reward to decrease? Like, do you think part of the reason why the reward is so great is because it's so hard?
My experience is that the calculations are pretty much the same as they've always been. Now, I'm not saying that HUD has not worked with us on increasing attorney expenses, just like Fannie and Freddie did as well, or increasing certain timeframes to allow for like their pre-marketing solution that they're trying to bring in and all that. So they have definitely worked on ways that keep their more complicated or their complicated, complex product viable on the servicing side. So they have, but the calculation pretty much hasn't changed since day one. So I think it is the intent to provide that as a minimum. That's, I'm not the person that made the rule, nor will I probably change the rule. So I would say that its stability speaks to its intent.
So look, I know you are as big of a technology nut as I am. With all the advances in workflow automation and AI, do you see anything big on the tech front that's going to increase or improve the efficiency in government loans?
On servicing, I think, so I want to make the distinction here that everybody makes if you're in an AI forum. So like, this is me, a novice, regurgitating that information. And that is, everybody uses robots as a service. Everybody uses OCR. We've got AI in functional service and for servicing right now. And some people have come up with their own proprietary enhancements to that, and they really love it. I think when people are talking about AI, like when we're actually listening to people talk on panels, everybody's wondering about generative AI. And that's the Chat GPT, the virtual agents, the library that builds itself kind of thing.
Right.
And that, I think operationally people are going to be really excited to use it. I think compliance and legally there will be complications around engaging. So I think it's a toe in the water unless you're what, Malcolm Gladwell might call an early adopter. Let's see how it goes. It creates immense benefit, but we always have to remember part of the risk of anything where you deal with anybody that does servicing, you're dealing with millions of customers over the whole entire ecosystem, and you've got to get it right.
Sure.
You've got to get it right because it's maybe not as simple as, this didn't reference the right table. I think you've got to be either an early adopter or you've got to be pretty certain that it meets all your needs, which I think is probably the big question for most people is, do I feel like I need all my needs met or 80% or where's my comfort level? That's just coming from a novice watcher. I'm not an IT. No,
but it's good to hear. It's an interesting perspective. Look, Candace, this was great. Really good information. I really think your perspective on the government-backed loans is interesting. Like, I think you're really digging into it from a different perspective than I think most of the industry sees it from. So I really do appreciate it.
Well, thank you very much. I once had a consultant when I was still a receptionist told me that the only way I would understand government loans is if I went and read the CFR and understood their 3 goals, and that anything outside those 3 goals was secondary. And as long as I could keep my brain on the fact that those 3 goals were what mattered, then I would be able to traverse the space with less consternation. And I think that that's probably what all of us could possibly do. If we understand those CFR goals, some of the noise fades away.
It's a good practice tip for anyone looking to get to your level. That's where you start.
Reading.
Today's discussion highlighted the complexities of government-backed loan servicing and what sets it apart from conventional non-government-backed loans. Candace Russell shared valuable insights on managing these loans and what's driving meaningful change within our industry. Thanks for joining Candace and I on the Weekly Friedman, your source for the most essential information in the default industry. Looking forward to seeing you next time, and thanks for tuning in.